All right, welcome back everyone to a brand new week ahead. Now, before we get stuck into the calendar, let's just quickly take a step back and see where exactly we're trading across major asset classes. I think the biggest story, not just for the past week, but really for the last 2 to 3 weeks, has been this sudden bout of risk off trading that we've seen popping up across the major asset classes, right? There's been a keen focus on those parts of the markets where things like positioning and leverage were the most frothy. Think of things like crypto, things like AI names, the high beta tech names. And if you just quickly take a look here at the cross asset view, we can see that things like the US dollar, normally considered as a safe haven currency, ended the week as the strongest currency. If we take a look at equity futures on the top right hand side, we can see that equity futures were lower across the board for the majority of the week. Same story for commodities. We had some brief upside in the mid of the week, traded back down lower, finishing the week down. And if we obviously take a look at yields across the curve, we saw downside, obviously upside for bonds, which again considered as a safe haven asset. Now, the most challenging thing about the recent risk of sentiment that we've seen, and we spoke about this last week as well, is that there just hasn't been a clear one-sided catalyst to explain this sudden bout of risk of sentiment. If you take a look at various assets, yes, there's been a few catalysts that could have contributed to the foul mood. There's been diminishing hopes of the Fed's rate cut, especially looking towards the December meeting. We had that FOMC meeting minutes last week, which obviously saw cuts or odds for a cut diminish, and then we had the jobs data and some comments coming out on Friday, which saw the markets nudge back up towards a 50-50. But bottom line is, yes, diminishing hopes of a Fed cut has been one of the drivers. There's also been continued concerns about elevated valuations, but when it comes to valuations, that is something that's been true since 2009. I don't think valuations is a good catalyst, or at least a good thing to pin down as a catalyst for the recent moves. But anyway, that's just me. Apart from that, there's also concerns about, like we said, the froth in some of those high performing sectors like the AI sector. There's obviously been some eye-watering gains in some of those names, and that has caused some concern. There's also concerns about the US labor market with, despite the jobs numbers for September last week showing 120,000 jobs added, the unemployment rate did jump to 4.4%. The market didn't like that. And then, of course, there could be some window dressing going into the end of the year, some good old profit taking could be a possible trigger. And then there's also, the problem of leverage, which I think is to blame for a lot of the carnage, especially in things like the crypto space, like we saw last week. I mean, if you take a look at some of these moves, they have gotten pretty crazy. And if you look at ETH, if you look at things like Bitcoin, they've been absolutely hammered this month. Bitcoin is down almost 25% after tagging close to 80K back on Friday, which was a pretty big drop to the downside. And this hasn't just been, about bad vibes about crypto or AI. It's been a couple of weeks coming, the grind to the downside, right? In terms of crypto specifically, there's been talks of massive ETF outflows, news of old wallets throwing in the towel. There's also been some comments about forced liquidations in the perps area and the perpetual futures, with loads of leverage dip buyers basically just running out of margin basically as we keep dropping. And then on top of all of that, there's also something else to consider, and this isn't just about crypto, but more about how over leveraged markets tend to operate. Is you also have options gamma flows, which can exacerbate some of those key breaks at key levels, especially things touted last week was the 85 and especially the upcoming 80 level. So what happens here is that dealers who sold a ton of options around those key levels like 85,000 or 80,000 or even 100,000, what tends to happen is when they sell a ton of options around those levels, they are essentially getting short gamma, right? Which means that their hedging rules will basically require them to chase price. If price goes up, they need to buy. If price goes down, they need to sell. So as we approach those big levels, whether it's 100 or 85 or 80, whatever it might be, as we approach those big levels where there's a lot of options activity, there is extra selling pressure purely from just hedging flows, right? And that helps price to basically crack through those big levels. And when that triggers more liquidations, which triggers more stop losses, which then again triggers more dealer hedging flow. So you get this like snowball effect. And, you know, these types of highly speculative markets and even some of those AI names, you know, where leverage is really a concern, that can be very susceptible to these types of liquidity cascades, if you will, where one thing triggers another. So the danger in this kind of tape is that, you know, perfectly normal looking selling behavior can suddenly turn into this like waterfall liquidity event, which to some degree you can argue has happened this month. It's been really, really ugly. And again, it's not just in the crypto space. This is where it's been hit the hardest. But if you just take a look at tech, you know, even though there hasn't been a key catalyst, the Nasdaq has struggled. Every single rally has been sold into. So things aren't looking very, very positive here. I mean, the Nasdaq itself, I think, saw its sharpest intraday reversal in months. That massive one that we had coming out on Thursday. There was just no real good reason for that move to the downside. Again, people pointed at AI, they pointed at the Fed, they pointed at the jobs numbers or the unemployment rate, more specifically. But again, nothing in terms of what we had explained that massive push to the downside. It speaks volume. I think the message here is pretty clear, and that is it's showing a market that is struggling to find a reason to stop the bleeding, you know, at least for now. And again, we are dealing with over leveraged and crowded trades here. So this momentum driven tape can really, you know, it flips the euphoria to air pockets very quickly. And that's why we need to be very, very cautious in these environments when we're trading right now. I mean, even things like NVIDIA, we had really solid earnings coming out from NVIDIA, and it just couldn't maintain any type of upside. We had a spike to the upside towards 196. And we basically finished the week looking pretty weak here. So overall, you know, not a very pretty sight to start the week with, to say the least. It wasn't all bad news, though. I mean, if we go back to central bank expectations here for a second, we did hear some comments coming out from Fed's Williams on Friday, which was considered slightly more dovish. And if you take a look at the aggregate of Federal Reserve members, the overall bias is still leaning slightly more neutral compared to everybody that's spoken recently, but more specifically to Williams itself, it did come across slightly more dovish. You know, he did say that you know, they could still definitely they could still cut rates in the near term, given that current policy is modestly restrictive. So that gave markets a little bit of a nudge back up towards a 50-50 or 56-43 in terms of cut expectations. So there was slightly good news on that front, but again, nothing to get too excited about. Apart from that, in terms of price action, the dollar, normally considered as a safe haven, also did pretty well. Not really due to safe haven flows, though. That upside trigger we had was mostly on the back of the FOMC meeting minutes, where the minutes itself, you know, last week saw cut probabilities drop down to about 27%. So we've gone from 70% in terms of cut probabilities. A week ago, that was 40, and then we finished the week back on 56. So we're basically right where we started, or very close to that at least, from the start of the week. So bottom line is, markets are trading very cautious right now. There's a lot of uncertainty in the mix. There's not a good enough reason, one particular reason we can pinpoint to explain these moves, which just means we need to be extremely careful. So with that out of the way, what do we have coming up for the week ahead that could potentially trigger some volatility for us? Now, apart from, you know, the ongoing price action that we'll need to watch, there's a couple of things we've got that's coming up that can be quite exciting for us. Let's first talk about, I think, the biggest one, which is the autumn budget from the UK, right? I think this one's going to be a key focus for the markets for a couple of different reasons. You know, the budget will be both interesting and possibly entertaining as well, because Chancellor Reeves, she basically has to convince markets that she can firstly plug a chunky fiscal hole of about 20 to 30 billion pounds, and also try not to crush an economy that's already limping along, right? So no pressure there for her going into the autumn budget. It's going to be a punchy one. Look, in terms of heading into this thing, The UK is in a bit of a squeeze. Growth is soft, inflation has been rolling over, and the markets are basically pricing in a strong chance. If we take a look at Bank of England expectations here, markets are pricing in a very strong chance of a cut for December at about 85% probability, about 30% price for another one in February, about 30% price for another one in March, about 40% price for another one back in April. So there's quite a lot of easing already, at least easing potential already being priced in by the markets. And at the same time, gilt yields have pushed higher recently on a mix of BOE repricing. There's obviously tax headlines. There's a lot of noise right now in terms of what's actually going to happen with this budget. And, compared to all of the price action that we saw, the pound has held up relatively well, I would say, over the past 2 weeks. We've had a lot of downside being priced into the pound as the market started to be really concerned about the fiscal situation in the UK. That saw quite a lot of downside in the pound. But over the past 2.5 weeks, I think it's held up pretty well, which might just be the case of markets wanting to see what happens to the budget before they put on new trades. So coming back to the budget then, what is expected for the week? The rough consensus is that there's a fiscal hole of about 20 to 30, let's call it 35 billion pounds that Reeves needs to plug somehow. And the main expectation is for her to do that via higher taxes rather than massive spending cuts. Now, there could be a little bit of both, but the broad consensus is that it could be a potential, like a one and done fiscal consolidation, right? A chunk of front-loaded tax measures now, more pain later though because of the threshold freezes, and she'll potentially look to add a little bit more headroom for a little bit of breathing space, if you will, on the fiscal front. That is the broad consensus. Now, that mix is more growth negative than markets were pricing in a couple of weeks ago, in my opinion. And layered on top of that, we now also have more increased expectations for BOE cuts. So all of that still leans more pound negative, which again is why I'm surprised that we haven't seen more downside. But again, I think it's more just the case of the markets now wanting to see what happens to the budget itself. Now, if we do get a consensus outcome, it is pound negative from a medium-term point of view, because again, you'll be increasing taxes. It's going to be growth negative. It shouldn't be very positive, but I do think a large part of this outcome was already priced in a couple of weeks ago. I do think this drop shows quite a lot of a decent chunk of risk premium already priced into the pound. So if we do get exactly as markets expect, which is like a 15 billion attempt to raise taxes to try and bring in another 15 billion. If we get something like that, we might see a little bit of a buy the rumor, sell the fact reaction in the pound. We could see a little bit of downside in gilt yields. We could see a little bit of upside in the pound as some of those fears of a even worse than expected budget gets pushed out. But since the consensus outcome is still not a positive for sterling in the medium term, I reckon traders will be looking to sell into any decent rips that we get, right? If we get a as expected outcome and we see the pound rally into some of those key levels of prior resistance or prior support, now resistance around, let's say 132.50, maybe even the 133.50, as we head into these key levels, I wouldn't be too surprised to see the markets using any rallies as an opportunity to short the pound. Because again, if we get the consensus outcome, even though I think some of that downside is priced, it's not a positive situation for the UK in the medium term. So there's very little reason to want to be buying the pound, as opposed to seeing a bit of a buy the rumor, sell the fact reaction, and then potentially seeing the markets fading that move entirely. There's also the chance that we get a softer budget, right? If we get a softer budget, that would be something like smaller or heavily backloaded fiscal consolidation from the Chancellor. Imagine lots of promises about future spending cuts that they will get. They'll be plucking pounds off the tree somehow, very optimistic about growth assumptions, but not much improvement in the medium-term deficit path. If we get something like that, it can be tricky, because initially, if there's lesser than expected tax hikes, that could be pound positive, as it means less near-term tax pain and less fiscal drag, right? That could see a little bit of a pop to the upside in the pound. But my biggest fear on that type of outcome, if she tries to play it too cool and she doesn't do the painful thing, the medium term is where this thing can bite, because if that happens, there is a chance that the markets react the same way that they did to maybe not in the same type of veracity, but think back to the mini budget that we had, right? If the investors don't buy the numbers, if she's too like blasé and she's like, oh, we're gonna save year and year and year, and we have all of these magical, puppy and unicorn plans. If the markets think we don't buy that, risk premium on gilts is going to widen massively, and that could spur talks of potential leadership changes, challenges to the PM, obviously a replacement for Reeves, which might be even worse of a setup that she's currently playing. And if that happens, I mean, the release valve would be a sharply lower pound, right? You would see gilt yields pop, you would see massive downside in the pound. So if she comes out and she doesn't do, if she can't control or show that she's got the fiscal story under control, things can get really ugly for the pound. I don't think she goes there. She's already prepped the markets to deliver some pain. But if she comes out and she tries to play it too cool, that could be really ugly for the pound. Again, initial upside, and then the markets will be like, okay, when are you getting replaced? And then they could smash pound quite aggressively. In terms of a hawkish outcome, she can also deliver a stronger budget, but again, that one will be just as tricky to trade. A stronger budget on the other hand would be Reeves going harder than expected. Clearly plugging most of the gap with meaningful front-loaded measures now. So locking in additional headroom, even more tax hikes coming in, even more spending cuts than what the markets are currently pricing in. In the short term, you would normally expect that to be pound negative, right? Because it means it means weaker growth, a lot more room for the Bank of England to cut rates. So initially, that could see the pound coming under pressure as the markets price in, a softer growth trajectory for the UK. But if the politics stay calm and the plan actually does look, dare I say it, durable or credible, if some credibility can be restored, that type of budget can help shrink the risk premium, which could actually see some upside in that release valve, which is the pound. So in that type of scenario, I think the real question would be whether markets will choose to focus on the risk premium reduction or whether they will choose to focus on growth and monetary policy. I think they choose to focus on growth and monetary policy, which is why I think even if they go down that route, that should still end up being a negative for the pound. But for me, as a trade into the event or out of the event, the simpler trade would be a consensus or a dovish outcome, which sees the pound maybe pop up initially and then looking for a fading opportunity if it presents itself. I think that's going to be the simplest way to potentially look to trade something like the autumn budget. Now, apart from that, also on the calendar that we can have a look at is the RBNZ policy decision that's coming up, I believe, on early in the day, on Wednesday as well. Now, in terms of the RBNZ, I'm not expecting much from this one, but it could be interesting. If you take a look at market expectations here from a central bank point of view, let's quickly go there. We just go to the RBNZ here. We can see markets are 100% pricing in another 25 basis point cut. Now that is on top of the already 225 basis points worth of cuts they've already did. They obviously surprised us with that 50 basis point cut at the prior meeting as well. And the main reason for this, despite the fact that Q3 CPI jumped to 1%, despite that, growth is still looking tired. Unemployment nudges up to 5.3%. Wage growth is cooling. GDP is shrinking. So there is reasons for why the markets are comfortable pricing in another 25 basis point cut. There is something worth just looking at right now, and that is that with inflation, yes, we know growth is bad. We know the labor market is slowing down. But, recent PMI data as well as some tourism flows have hinted that the worst of the downturn might already be behind the Kiwi economy. We also have inflation, like I say, jumping to 1%. We've got annual inflation back up to 3% with non-tradables, doing most of those damage. So the price picture by itself and looking at the PMIs, both of those two things doesn't exactly scream that they have to cut rates, but the markets just think that, listen, they've basically prepped the markets that they're going to cut again. They might as well just take rates down to 2.25 and then just allow themselves some breathing room for those things to pass through and help the economy. So in terms of consensus is skewed towards a cut of 25. If we get that 25 cut, I think that's mostly in the price. So the base case is that the Kiwi just stays in a bit of a similar range that we've been trading in recently. There could be some medium-term upside if the narrative starts to shift to the potential recovery that's ahead, and obviously focus on the fact that now they are potentially done easing rates. But in terms of the initial reaction, if it's just a cut, then there might not be as big of a reaction. What about a possible dovish or hawkish outcome? On the hawkish side, with a 25 cut already baked in, something that would surprise here is that if they clearly say that there's more to come after this 25, or imagine they do another 50 basis point surprise like they did in October. I mean, if you think about it, we are at 2.5% at the moment for the OCR. Just take it down to 2% and then just let things ride from there. That could obviously give them some breathing space. If we do see a 50 basis point cut, that would obviously see immediate downside as the markets need to price in that additional 25 basis points worth of easing. But after an initial sell-off, it could actually be seen as a positive. Right? If the OCR is at 2%, that means they are most likely done cutting rates for good. And that could actually set up expectations that, okay, now they're done cutting rates. We're not expecting any more. They've cut bigger than expected. Maybe this could provide that buffer for a potential recovery. So a drop and a potential fade could be something to look at in that scenario. Especially if the Aussie CPI data that we have coming up just ahead of the RBNZ on the same day, if that comes in weaker than expected, that could set up a really nice opportunity for a possible pop and fade, if you will. If you take a look at the Aussie Kiwi, the pair, which is normally my favorite to express things like this, if it's a surprise cut, we probably trade back up towards that 116.50 area. And then if the markets realize that, wait a minute, this could actually be positive, we could actually see that thing turn around. So a possible pop and fade could be an opportunity. And obviously, there's also the chance of a hawkish outcome, right? Imagine they don't cut rates when everybody expects them to. That could obviously see the markets pricing out the cut that's fully priced in. Or if we get that 25, but wrapped up in a very firm guidance signal from them saying that this is the end. We don't see the need to cut the OCR anymore. If they leave the OCR track basically unchanged, and sound more optimistic about the potential for a recovery, that could obviously see a little bit of a short squeeze playing out. In that scenario, it probably doesn't matter what the CPI data for Australia prints. That could still offer a decent move to the downside for the pair. If you take a look at this from a purely differential point of view, if you look at things like the implied volatility as well as risk reversals, let's just go to the Aussie Kiwi, both implied vol as well as the risk reversal is trading at some pretty significant levels. Both is considered pretty expensive here. And if this starts to roll over, if implied vol starts to die down as well as risk reversals, you would expect the pair to follow suit as well. So not something that I want to be trading now. But again, if the bank comes out and they either surprise by not cutting or cut, but they give a stern signal that we are done now and they sound more optimistic about growth, that could be a really good opportunity that I would be looking at for the Aussie Kiwi, which is trading at some pretty expensive levels itself. Now, apart from that, a few other things we need to watch out for the week as well is on Thursday we've got US the Thanksgiving holiday coming up, which means that we should expect thinner liquidity as well as volume, basically from Thursday. What does that mean? Well, in the current context, where we have all of this volatility running around, we need to be a little bit mindful of that, right? I mean, take a look at what's happened to cross-asset volatility. If you look at the last 6 months across the board, whether you look at FX, whether you look at equities, doesn't matter where you look, volatility has been picking up quite aggressively across the board in the very short term. Now, if this is already high, imagine when half of the US market or a large chunk of US participants just doesn't trade Thursday and Friday. That could make things very hairy, especially if we get those same type of moves like we saw last week. So just be careful that could add a lot of volatility just because we have a lack of participation from so many traders. Apart from that, also looking towards the calendars, we have month end, right? Friday is the official last business day of the month, which means we have corporate month end on Wednesday and official month end on Friday. What does that mean? It means in the FX space, we could see some pretty outsized flows towards the London fix, which normally takes place 4 p.m. UK time. So be aware of any weird moves that you see, either aggressive dollar selling or aggressive dollar buying, sometimes traded against things like the pound, or mostly traded against things like the euro, the pound, the yen. If you see big moves in those types of pairs, it might just be down to month-end flows, corporate flows. So just keep a quick eye on that. Apart from that, we also have a couple of US data points coming out this week. I mean, we've got the retail sales data, the PPI data. I'm not expecting these things to matter a lot. Yes, it is PPI, so it is something we will be watching, but if you take a look at how the markets reacted last week, with the, despite the fact that we had a mixed print, I don't think a lot of the reactions we saw last week was purely driven by the US data. If you take a look at the dollar itself, it was pretty much a nothing burger in terms of that jobs numbers. So I don't think these data points matter, but obviously it is US data, so it is something just worth keeping on the radar. But I think UK budget, RBNZ might offer us a little bit more bang for our buck for the week ahead. So with that said, I hope everybody will have a fantastic one. As always, any questions, don't hesitate to let me know, and I hope you guys have a fantastic week ahead. All right, welcome back everyone to a brand new week ahead. Now, before we get stuck into the calendar, let's just quickly take a step back and see where exactly we're trading across major asset classes. I think the biggest story, not just for the past week, but really for the last 2 to 3 weeks, has been this sudden bout of risk-off trading that we've seen popping up across the major asset classes, right? There's been a keen focus on those parts of the markets where things like positioning and leverage were the most frothy. Think of things like crypto, things like AI names, the high beta tech names. And if you just quickly take a look here at the cross-asset view, we can see that things like the US dollar, normally considered as a safe haven currency, ended the week as the strongest currency. If we take a look at equity futures on the top right hand side, we can see that equity futures were lower across the board for the majority of the week. Same story for commodities. We had some brief upside in the mid of the week, traded back down lower, finishing the week down. And if we obviously take a look at yields across the curve, we saw downside, obviously upside for bonds, which again considered as a safe haven asset. Now, the most challenging thing about the recent risk of sentiment that we've seen, and we spoke about this last week as well, is that there just hasn't been a clear one-sided catalyst to explain this sudden bout of risk of sentiment. If you take a look at various assets, yes, there's been a few catalysts that could have contributed to the foul mood. There's been diminishing hopes of the Fed's rate cut, especially looking towards the December meeting. We had that FOMC meeting minutes last week, which obviously saw cuts for or odds for a cut diminish, and then we had the jobs data and some comments coming out on Friday, which saw the markets nudge back up towards a 50-50. But bottom line is, yes, diminishing hopes of a Fed cut has been one of the drivers. There's also been continued concerns about, elevated valuations. But when it comes to valuations, that is something that's been true since 2009. I don't think valuations is a good catalyst